Okay, so we're now recording.
Fantastic. And that screen's come up okay, David?
That's fine, yeah.
Brilliant. Welcome, everyone. I hope you're all tucked up warm. It was a colder morning here in Auckland today with a little bit of our normal winter rain. Yeah. Ooh, I'm in a nice cold boardroom which has no heating for some stupid reason. But there you go. I've got my jacket on, I've got my woolies on, I've got my coffee, and we're going to get into it. So today's session, the code cracker, and why the code applies potentially to all advisors. And the reason we put this session together is because there have been some changes to the code of conduct for authorised financial advisors. When there are any changes, obviously everyone's interested in how that affects them. So for authorised financial advisors who have had a look at them and wondering what it all means, you're going to find this session interesting and very applicable. But for other advisors, we're going to actually look at how they can help you with understanding your regulatory requirements as well. As usual, this is a class advice session rather than a personalised advice session. So if there's anything that pops up out of this, please feel free to contact David at the NZFAA if you've got any questions, and also we're available at IDS for any questions you may have that pertain to your particular situation. So, the AFA Code of Conduct. Obviously, the first question a lot of you might be asking will be, well, why should an RFA, why would an insurance or a mortgage advisor worry about what the code actually has to say? There are two sections in the code, I think it's 34, 35, in the Financial Advisors Act, which state that all advisors must demonstrate care, diligence and skill, and they must not mislead or be deceptive with their financial advice services or their personalised financial advice services. Obviously, it's a principles-based legislation. What does care and diligence and skill actually mean? And what does not? Well, misleading and deceptive is probably a little bit easier to define. The AFA code is designed to give specific, practical steps of expectations of what the regulator would require for somebody dealing in investment products, which shows how they demonstrate care, diligence, and skill. What we tend to find, and over the last probably 5 years actually, where we have seen insurance, mortgage and investment advisors have a complaint that is investigated by a dispute scheme or an FMA investigation into conduct or court cases, what tends to happen is that it doesn't matter what sort of advisor you are, the question seems to be asked is, well, what would a reasonable advisor have done in that situation? Or in some cases, the judges especially will say, well, what is best practice? In this day and age, in the past, we have seen court cases whereby they'll bring in a subject matter expert who might be someone from a professional association, for example, and the professional association will go, well, here's the practices that we would recommend are best practice. And so therefore, an advisor who is in the court case may end up having the process they used measured against whatever was considered best practice by the judge and the subject matter expert. And I guess the suggestion I've got for you today, really, or the theory behind today's presentation for RFAs is that the code is the regulator's thinking of how a reasonable practices should be taken. Specifically, they've aimed that obviously at investment advisors. And if you look back as to why the Financial Advisors Act actually exists, the thrust behind that is to increase confidence in the financial markets in New Zealand and so therefore investment's a key part of that. But I would contend that in relation to mortgage, insurance, foreign general advice, the same theories of reasonable practice would also apply. So then the reason for that then is why we would say, look, take a look at the code, be cognizant of what it says, because if you were to ever be measured against best practice, then that would be a good place to look. So I've got a question here of when did the new code start? David, have we got a poll for this question?
Well, for some reason the polls haven't come up. So let me I'm going to set it up now. give me 1 minute.
Just one minute. So yeah, the code changes have come out, and we will just ask you to see who knew when the code came out. And you can get copies of it, obviously, from the FMA. AFA should have all been sent a new copy of it. If you haven't got one, it's always good to have beside the bed. So if you're having any trouble sleeping, you can pull out your code of conduct, and within 2 pages you'll be asleep. I promise you.
Okay, so hopefully I've got a poll now that
okay.
I have. It's ready to go.
When did the new code start? And the options you have are 1st of March 2014, 1st of May 2014, or the 1st of June 2014.
So I've got 1st of July, my error. I've got 1st of July now. So for those of you who haven't done this before, you just basically tick one of the boxes, and we will then just sort of show the aggregate results at the end. So only half the people have voted so far. Oh no, just over. Countdown 10, 9.
The others are just finishing the Google search.
Yeah. 8, 7, 6, 5, 4, 3, 2, 1, go. Okay. There's the results. I'm not sure if you can see the results on your screen, Barry. The 27% said the 1st of March 2014, 39% said the 1st of May, and 33% said the 1st of July.
Nearly a third. Well, those of you that chose the 1st of May, you are 100% correct. But it was quite interesting. I presented at a room full of, well, 30 AFAs at the end of last month, and I asked the question as well, so when did this start? And it was one of the first questions I asked, and no one put their hand up, so I was a little worried. Maybe the FMA needs to do a bit of work on their PR. Okay, so 1st of May, these changes have been in. Some people have asked why did they change the code? Well, obviously the original code was put in place 3 years ago, and since then there have been probably 5 guidance notes as well as other comments or communications from the FMA to try and clarify what the code committee meant by some of the descriptions in the code standards. So for example, early on, Code Standard 6 had some requirements around making recommendations on financial products, and that they have to be analysed by the AFA to a level that provides a reasonable basis for any such recommendations. Now, when AFAs first read that, they suddenly went, well, hang on, I advise on, global equities trusts as part of a balanced fund. Am I supposed to, analyse whether or not the global equities are correct in that fund? I mean, what's reasonable, and what are you talking about? So what they had to do was quickly come out with guidance notes to say, oh no, that's not what we meant. And of course, no one likes living in the grey. They want to know for sure, what do I have to do? So sometimes having principled regulation is useful in the fact that it gives you guidance without giving you strict rules to follow. But then in some instances we found actually we would like a ruling because we'd like to know what we have to do. So the new code, and I must admit, I'm personally pleased. I think David Island and the Code Committee have done a good job of clarifying areas that previously were left a little grey. So the key code changes that have been made And the 8 key changes we've sort of picked out of it to have a look at today really give us, I think, some good points to discuss for all advisors. Things around like the scope of service and engagement and how to define that. The use of transactional product advice is an interesting one. It's one we see a lot where advisors say, oh, I gave no advice. And we sort of go, well, you must have given some advice because they took a product or they cancelled a product or did something. Conflicts of interests, the relying on others for research, which goes to the point I just made about Code Standard 6. Also, they've better defined when they say they expect to see things in writing, what they're looking for in writing. And a really key change to that written advice part or the written service agreement is also that the client can actually have some choice about what information they wish to receive and how they wish to receive it. And that goes, for those of you that have followed the Compliance Matters, you'll know that we're very keen to try and break down the information to clients to match key decision points. And so we were really pleased when we saw some of these changes, which we're going to discuss in a bit more detail. At the bottom there, you'll see that there's CPD planning and there was some sunset provisions around the Level 5 certificate, Set C changes, and David's going to have a bit of a chat to you about the CPD changes towards the end of the session today, and also how that relates to the NZFAA structured requirements. So we'll start at the beginning. Code Standard 1. Now, interestingly, when we have seen complaints or investigations into advisors and whether or not they've met code standards, also when we've had guidance notes about what an advisor should do for a particular code standard, whether it's meeting client care or something like that, the regulator has always at the end of those guidance notes stated that, hey, don't forget, it all relates back to Code Standard 1. So they've actually added, or the key change they've made to the code standard was that these obligations are paramount. So in the past, the industry's talked about fiduciary duty, and really that's what they're laying on here, is they're sort of saying, if you're going to be doing anything, when you're providing a financial advice service or giving financial advice, personalised financial advice, that advice needs to be putting the client first. They then go on under each code standard, if you haven't read them, to define what that actually means. So as you can see, Code Standard 1 applies irrespective of the application or effect of any other code standard. We've had some interesting cases in the past where, for example, an advisor may have not followed a code standard, but the outcome for the client was positive, or they ended up doing the right thing, but they didn't meet the code standard, and you end up in this situation a bit like with your maths teacher. The maths teacher used to say, well, you got the right answer, but you didn't show your workings. And other times they might go, well, you showed your workings and you did the right thing, you just got the wrong answer. The FMA is almost implied that both of those could be right, which is a little bit grey in its own right. Now, one of the areas that they've tidied up with this code standard definition was that if you were authorised financial advisor who could provide financial advice services, investment planning and DIMS, for example, there was almost an assumption there that you had to provide all possible services to a client. And so what they're actually now saying is that AFAs are able to provide services that are they're not required to provide services which aren't in scope for the AFA's services. The key for that is that the AFA can advise clients, and I'll give you an example we see with investment advisors. A lot of them might say, well, I'm able to provide full financial plans and full financial plannings as a certified financial planner. Yet when we talk to the advisor, they may say, well, actually, these days I don't do financial planning. I've just provided an investment planning service, which is a subset of financial planning. But in their, but they think they have to offer clients full financial plans because of the code requirements. So what this is saying is, no, you don't. You can actually say, yes, I am authorised to do full services, but actually I only do this. How does this actually help you? As RFAs, mortgage brokers, or as well, if you can demonstrate that your services are designed to put the client's interest first, then you're going to pass most compliance tests as it relates to the principles of care, diligence, and skill. So if you've said we've designed our process to give the client the outcomes, I mean, as you know, we do what we say on the box, then you're, and I guess the question is, people say, well, how would we demonstrate that? This is where advice comes maybe different from providing a product. And it's something we've discussed previously. There are times where an advisor might give advice that says, actually, you should just stay where you are, or that the advice I give you may not mean that I get paid a commission or any benefit to you. If you can demonstrate that that happens at times with your process, then that's a good demonstration that you're putting the client's interest first. An example of this from the FMA is under the care, diligence and skill section of their website when they talk about replacement business. And they have actually stated that what they would expect to see in the event that business is replaced. And they also suggest that they would look and see how often a financial advisor recommends replacement in their practice. So that would be a good example of them saying, well, hang on, are you always recommending replacement, or do you, is there a way that you don't?
That raises an interesting dilemma, doesn't it, Barry, in terms of obviously when you're talking to the client and when you're giving advice to the client, there's a by default there's a conflict there by virtue of the fact you're in business. So at the end of the day, you've got to factor into the equation the needs of the business to continue, which potentially could conflict with the needs of the client in extreme circumstances.
Yeah, and look, Tim Williams from Chapman Tripp, I can still remember when we were met with the code committee on the first draft of the code. And obviously the first one comes up to put the client first. And he said, well, unless you put that it's something about being reasonable, or that could be considered reasonable for somebody who's in business, like, we run commercial entities. We're all in business to make money. So, but if you took the way this code standard's written, theoretically we would do everything for free, because that would be in the best interest of the client. There is, and David Ireland and the code committee, while they took that on, they said, we get that, we understand that people will have to make money, but we have to know that they're not going to give advice that disadvantages the client or isn't in the client's interests to make money, and that's the bit we've got to watch. So there is a really fine line between the intent of the service, I guess, is what they're looking at.
As I say, it's an interesting dilemma.
I guess what I try, and I get clients asking me, well, what, and I say this when they say, well, how do I know whether I'm giving good advice? And I just say, well, swap seats with the client. Imagine you were sitting in their shoes. What would you do, or what would you want recommended for you to do if you were in their position? Or imagine you were giving that advice to your mum, I don't know, something like that.
Yeah.
Okay, I'm going to do the right thing. Now, if you find that your business model or the way you do it means that you're never making any money, well, that
raises a more fundamental concern, doesn't it?
And look, I've had it with financial planners go, gee, I do all this great work around cash management for clients and debt management, getting them all sorted out so that that's all sorted before we look at insurance or investment. And that takes a whole lot of time, but there's no product money in it for that. And people don't necessarily want to pay for financial advice either. So there has to be that balance of, well, I need to make some money and I need to do the right thing by the client.
Mm.
But I guess my point here is that if you show that, you know, and we've just, I don't think it's one of the case studies here, we've just had a client complaint investigation with the FMA that we've just been involved with, and it was around a claim of was the advertising misleading, and the statement basically was that we can help the majority of clients either save money on premiums or get better cover. And the FMA said, prove it. Prove that you can do that the majority of the time. And we did. We had to go backwards and go, for all clients who responded to that advertising, who sat down with an advisor, how many of them were able to get either better premium, reduced premium, and or better cover and advice. And so, you know, it got down to 34 appointments, you know, 19 props, and, you know, they said, oh, we still don't know whether that's enough evidence to make that claim, so they wanted them to stop making that claim altogether.
Wow, and that was the outcome of that discussion, was it? That complaint?
Yeah, and that was an RFA insurance advisor. So, so yeah, interesting how they, even though they showed evidence from one, they still reckon they closed the thing, but it's on file. It's one of those, it's closed, but it's not closed files.
Right. So they'll be monitoring that.
I would suggest they would be. Yeah. So the other key thing around Code Standard 1 was the services. So you can actually limit the scope of services up front with the clients. So the types of advice or the types of products you advise on, even things like product providers, you can say we have preferences or we only deal with certain amounts. It must be in writing though. So for we always recommend that having a terms of an engagement or an about us up front that says here's what we do and how we do it. And that might be different from the way other advisors do that. So within insurance, we might have people who go, hey, we do insurance planning. We put a whole lot of plan together to calculate all the risks and figure them all out and make recommendations on products and how you should structure it. Others might just go, I sell life insurance, trauma insurance, income protection insurance. I'll tell you what they are. You tell me whether you want it and how much. Two different levels of service. But, you know, you can actually make it clear up front. Code Standard 5, this was quite a major change to the code in the fact that Code Standard 5 previously talked about that a financial advisor must not provide financial advice to a retail client in relation to a product that's not offered to the public if the authorised advisor is related to the product provider or that financial product. I guess basically what that was saying was you couldn't sort of set up your own investment trust or, you know, something you were related to. Also, as far as conflicts of interests were concerned, the only mention of that was under Code Standard 6 about behaving professionally. And it was a small comment in the description which just said that an advisor must transparently manage any conflicts of interest that may arise from providing the services. So what they did was they lifted the part out of Code Standard 6 and rewrote Code Standard 5, saying that the advisor must effectively obviously manage conflicts of interest. Previously we've discussed, you know, what is a conflict of interest. I guess the easiest way to define it is it's where a person must choose whether to advance their own personal interest or those of others. The way they've defined it, and the interesting thing is they've said that the AFI needs to identify and clearly and effectively communicate all interests of the AFA or a related person that might influence the services the AFA provides to the client. So what they're saying there is that if if there are benefits that will arise from the recommendations of the advisor, and they might not go directly to the advisor, they may go to the business that they are part of, then really they need to communicate those to the actual client. The other bit they've put on there is if they're unable to manage the conflict of interest so as to place the interests of the client ahead of the AFA, then the AFA must decline to act. And once again, this gets into some interesting space around this, whereby if the advisor is part of a product provider, or where they are the product provider, so they've set up a particular property investment scheme that they are party to, and they're going to give personalised financial advice which recommends a client goes into it. So what this part is trying to do is for investment advisors is to separate their role as giving financial advice to a client about savings and retirement, and then recommending that they use their own investment product or managed fund to achieve that, because they're sort of saying, well, you're clipping the ticket of both ends. This also goes to the heart of the DIMS issue, the discretionary investment management issue of, well, what service are you providing? Are you providing financial advice, or are you providing a financial product? Now, how does this help RFAs? If your business can demonstrate that you have identified any conflicts of interest or potential conflicts of interest, are they managed and are they disclosed? Now, there's nothing that states in the legislation that an RFA has to disclose even how they are remunerated for their services. I actually don't look at this even just from this issue from potentially a financial advice regulation, but more from well, what would I expect in business? So there is a commercial relationship between a mortgage advisor or an insurance advisor and their clients. So actually stating how you get paid for the services you provide is very important. I see some excellent statements or terms of engagement provided by insurance advisors where they state the methodology behind their remuneration. So for example, some advisors work on a low upfront but high renewal basis, and their thinking behind that is that means that they will be able to be paid in the future to provide an ongoing service or claims management for the client renewals. And they actually state that to the client, say, hey, this is how I'm going to get paid and this is why I think it benefits you as well as our business. I think there are times where clients don't always understand some of the natural conflicts where commissions are involved with products, in the fact that the only way I'll get paid as an advisor is if I recommend a new sale, and that's a natural conflict we potentially have in those areas. So disclosure of how remuneration works, and if there are any conflicts of interest, that those are disclosed as well. So for example, if you own shares in an insurance company, then you should disclose, and you're recommending that insurance company, that's definitely something you'd be looking to disclose, because if the client found out afterwards in the event of a complaint, that could definitely be seen as a conflict of interest and potentially misleading.
There's an interesting disconnect here between the obligation disclosure, the legal disclosure obligations of an AFA and an RFA. I mean, I had a conversation with an AFA earlier this week, in fact, talking specifically about the disclosure obligations as an AFA. What they were doing is they were moving away from the investment space and heading more towards insurance. And they were frustrated that they were having to disclose commission arrangements sufficiently in a sufficient level of detail to enable the client to work out how much the advisor is going to get paid. Whereas their colleague down the road as an RFA has no such obligation, and or at least no legal obligation. But it goes back to this question here as to whether, in fact, the client is able to make an informed decision, and what information do they need to be able to make that informed decision? Doesn't it? I mean, it seems a bit strange that we've got this quite significant disconnect between the role of the obligations of an AFA and an RFA.
Yes, and it all leads back to, sort of what happened back in 2008, where the Financial Advisors Act was coming in, and the focus was on investments, and they decided that there were no systemic issues with any other financial advice, so therefore they got left out of these levels of disclosure requirements that AFAs have got. But in saying that, I just look at it almost from a commercial point of view. That I think it can be quite a positive, or we recommend, and we've just done some work recently with an insurance brokerage, whereby we have put together a terms of engagement for them to use with their clients. And it does cover off a lot of the things that would be covered off potentially in a secondary disclosure for an AFA. But it just discusses it up front. Hey, we're going to do some work for you. By the way, you don't have to pay us for the advice component. In fact, in their case, the advisor was salaried, so they stated that, hey, the advisor was salaried, but they did go on to state, we will receive, the business will receive commissions. So, it's a related body if you place any business with us. And then it went on to say, but here's our service proposition for reviews and claims management. And they also stated that if we're going to prepare a business plan and advice for you, and we end up recommending insurances, but you choose not to proceed, that there could be a fee payable for that advice. So what they're trying to do is demonstrate that, hey, there is a whole lot of value we deliver, and we don't just do it as a free, public service. There's actually a cost to it. Generally, commissions cover it, but if not. So yeah. I think it should. I think it seemed to me it would be quite professional to have a terms of engagement with your client to state, hey, here's what we're going to do. Here's what we expect you to do. Here's how we get paid. Do you understand that? Great. Let's get on with this relationship. And it could differentiate you from other product selling advisors. Righty-ho. I've got a little case study here, and this was a real example from a review we did. So a client came in to see, or a client was recommended to meet an advisor. The advisor happens to be an authorised financial advisor who offers pretty much all services really, mortgages, insurance, KiwiSaver and investment planning. During the discussion, they were looking at some insurance advice for the person, and the client also stated that they asked the question, are they in KiwiSaver? And the client said that they were, and that they were in a default fund and they hadn't even looked at it. So therefore the client has actually received no KiwiSaver advice, but they were saving and their employer was contributing. As part of the advice, so there was some insurance advice that was going on as part of this engagement. The advisor then did a statement of advice for the client. They did a risk tolerance to suggest that they should be in a particular fund, and the advisor recommended, said you should be in KiwiSaver. It's actually quite interesting. The statement of advice talked about they'd received $1,000 from the government. They get the tax bit rebate. It talked about the benefits of KiwiSaver and why they should be in it. It then stated that we recommend this particular company, and the reasons you should move to this company are because they're New Zealand owned, they offer quality service and great investment team. Now, that all sounds really good. As part of, when I looked through the documentation as well, as part of the secondary disclosure, which gets given out with the primary disclosure, it mentioned that the advisor is actually a shareholder in that KiwiSaver provider, though the statement of advice doesn't mention that specifically to the client. There's also in the statement of advice, there's no comparison between the two schemes. So there's nothing to say, well, here's the fund you're in, and here's the provider, and here's the costs, and here's the fees, etc., etc. It also, the advisor was going to receive 0.5% on ongoing. That was actually put into the report, but there was actually no personalised secondary statement, which is a requirement for AFAs. So my question to you is, do you think the advisor met Code Standard 5 with that advice? Happy to take any questions on the case as well before you answer the poll.
So I'll launch the poll.
Yeah. David, do you have any questions or comments?
Let me just go back to the. Can you just go back to the case itself? Let's just close the poll for a second. Let's go back to that one. Oh, I missed. I think I've accidentally closed the poll. That wasn't very clever. Apologies. I think there's one comment there which I think is interesting, is where one of the reasons that they make for recommending is that it's advisor focused.
Mm.
I would,
in the statement of advice.
Right, I wouldn't necessarily consider that to be a very valid reason for moving KiwiSaver. Is that right? I mean, would you agree with that?
Yeah. Look, it's an interesting comment, and I think what the advisor was trying to say was that when an advisor is involved with KiwiSaver advice with the client, that this company, means that they can have the marriage of three. If you think about that, if a client has a bank KiwiSaver, and the KiwiSaver provider doesn't recognise an advice relationship, then it may be that the advisor has to get the client to give them all the information and updates on how their KiwiSaver is doing in that particular bank KiwiSaver.
Understand.
So,
yeah.
Whereas if they're with an advisor-focused company like your OnePaths or your Generates, Fishes, potentially, where they'll actually pass information to a recognised advisor, then it's easier for the advisor to manage the KiwiSaver with the client.
Yeah, there's some obvious. I guess I hadn't looked at it from that context. There's some obvious client benefit from that arrangement.
There could be, yeah.
The other question: did they disclose potential remuneration arrangements across all the products they deal with?
Yes. Though in this particular case, they give out, and why I said 5-page secondary, it is a very extensive disclosure. But it's almost like, because they describe every remuneration they receive from all insurance companies they deal with, mortgages. They also describe fees that they potentially charge for advice, and it's all not personalised. So probably in this particular case, 4 of those pages were not relevant to this scope, to this engagement. So we would have expected to see for an AFA a personalised secondary statement saying, for this advice I've given you, I've recommended this insurance provider and I'll get paid this, and I've recommended this KiwiSaver and I'll get paid this, and there are no fees or charges for the advice.
Right. And the
interesting point is, one interesting thing which I haven't mentioned there was that the statement of advice written for the KiwiSaver was actually software provided by the KiwiSaver provider as well.
Right. When was this a secondary disclosure presented?
Up front, when they at the initial engagement meeting, they give the primary and the secondary at the same time.
Okay.
So what they're sort of relying on is that the client, after they've received the advice, will go back to that and figure out, and I don't know how they'd figure out because it would be quite, I think, quite difficult, what the advisor would actually get paid from it.
Mm. My apologies for closing the poll. Of those that did vote, and pretty much the vast majority said no, that it didn't meet Code Standard 5.
Yeah, and this is a good example. When I questioned the advisor about the advice, and I said, what was the reason for the recommendation from that scheme to scheme B? They gave me the reasons that sort of in the code. I actually, I don't know if anyone, well, I actually said, well, that's rubbish. Tell me the real reason why. He says, because I couldn't be the advisor because they were in this other KiwiSaver fund and that don't have advice relationships with. And I said, but you could still give them financial advice about KiwiSaver and potentially get them to move it themselves within that fund. And then, of course, he said, but then I won't get paid. Now, at that point, he sort of said, oh, okay, I get that. I said, so what you've actually got to do, if you think it would be better for your business if the client was in company B that you're recommending, you could say to the client, our preference is to have our clients in here because we can manage you this way, here, here, and here, and this is how we get paid for that. Here's where you are, and here's the differences between the two funds. I'm not going to recommend you move. I'm just going to allow you to make an informed decision. I would imagine 9 times out of 10, the client will still move. But at least it would demonstrate that they've made an informed decision to pay. In this case, the fees were actually higher, and the fund returns, if they were in the corresponding fund with the default fund they were in, were actually better off as well. So it's actually quite a tough argument from a product point of view. But it just goes to show that the decision, the conflicts of interest were not, I don't think, managed and clearly disclosed, and the client wasn't put in a position to make an informed decision. So the client's interests, I don't think, you go to Code Standard 1, the client's interests weren't taken into account with that advice. So I think they failed probably Code Standard 1 as well. So there you go. That's and that's probably not an uncommon occurrence. Righty-ho, Code Standard 6. Authorised financial advisor must behave professionally in all dealings with clients and communicate clearly, concisely, and effectively. Effectively is, I guess, a new part to this in a way, or it's one of the ones they've definitely highlighted. We can always, we think we correspond or communicate clearly. We're not always concise in the communications we have as financial advisors. We provide a lot of information to clients. Effectively, though, and the judgment for that's quite an interesting one. What we want to be able to show is when we make recommendations on a financial product, that the advisor has a reasonable basis for that recommendation. The good part of, one of the good parts of this is that you are actually now allowed to rely on another person to assess the products. So previously it was relying on the AFA to do it, but now they're actually saying, well, you can rely on another if it is reasonable. And I'm going to talk a little bit about how that affects all advisors as well. The other one is taking reasonable steps to ensure the client understands the communication. For those of you that have looked at our deconstructing the advice process, that's one of the things we're trying to do there, is if we communicate the scope of service and the needs and get them to say, yep, that's what I want, cool, then go back to them and go, well, here's the options. They make a decision. Did they understand that? Yep, good. Then we implement. Happy with implementation? Yep. Rather than just generally the one sign-off that we see in a lot of advice processes. How does this help you?
Just to refer back to that for a second, Barry. For those of you that either didn't get involved or would like to go over that deconstructed process again, we've got videos on our Vimeo channel, so let me know if you'd like access to those.
Fantastic. Now, how does this help you? The good thing is that you can actually rely on using external research. And it must be reasonable. So there are times where advisors do their own research, though they don't always evidence that if they've done that research. One of the things we always recommend for advisors is so for mortgage advisors, if you attend product information sessions from providers and lenders, and I know they're having them more often these days. But if there's any way that you can record how you kept up to date with the products that you advise on, you should record that, because that's your own research. For insurance advisors, for the product providers that you deal with or give advice on, completing product accreditation is a really good way to show how you have done your own research. But if you are going to use external research like quality product ratings, the IRIS research, or strategy, then the key there is showing, well, do you understand how their research works? So it's almost like you need to research the research before you rely on it, I guess is what I'm trying to say. Do you understand their methodologies? Examples I see where advice states, I'm recommending this product because it rates well on strategy. For example, I then say to the advisor, oh, have you got the strategy sheets that you used when you did the research? They'll say, for this particular file, they'll go, oh, no, but I got the rating sheet given to me. And I'll go, who gave you the rating sheet for strategy? And they'll say, oh, the BDM. And it just happens to be the BDM for the company who they've ended up recommending to the client, funnily enough. So I would suggest if you're going to rely on research, you're going to have to go, well, why did you choose the company you choose with? And also I'd suggest that I would keep copies of that research. There was a court case last year where they stated that they used research to say that one company was better than another one when recommending replacement. When asked to produce the evidence of the ratings, they used the current ratings instead of the 2004 ratings as when the advice was given. Well, unless they go back to the research provider and say what were the ratings back in 2004, then it almost becomes not evidence of as such. The good thing is, and I'm going to talk a little bit about it as part of one of the other code standard changes, is you don't actually necessarily need to provide the research to the client either. So don't feel as though you have to add that all into your reports or put it in as appendices. You can mention that you relied on it if you did as part of your statement of advice, but you don't need to give it to them unless the clients particularly want to see it. The other thing that I really like about this code standard is it does say clear and concise. So you can actually keep it as short and sweet as possible. And the key part is that, does the client understand? So for example, in most files that we review, we may actually only see the client signing an application as evidence that they've accepted the financial advice that went before it. They may just be signing the application because they don't understand it, but they really like you and trust you. And it would be good to know when the difference is. So if you can demonstrate by them signing, receiving your terms of engagement, for example, about how you're paid and the services and the limitations of your services or products that you deal with, and that they accept that, and then show them that they've agreed with the objectives or the circumstances of the advice, or agreed to the advice, and then there's an application signed, I think that would demonstrate that you're communicating effectively what's happening with your advice. So yeah, something to think about as you go through your process. Code Standard 8. We must make reasonable steps to ensure that the personalised service is suitable for the client. What we're looking at here is, and this is the bit that, if we go back to traditional financial planning, of stating, well, I understand the client's financial situation, their needs, their goals, and therefore the services I'm providing meet and understand those. We're quite glad that this code standard's been defined a bit further, because previously the worry was that if a client had a product with you, that because they've got a product with you, that you have to know all of these things. Because of the changes in the code now, you can actually have a client who has limited your services to, I just want you to implement a product without giving personalized financial advice. But when we do give a personalized financial advice, then obviously we need to ensure that we have an up-to-date understanding of where the client's at. So, where a client declines to provide information, so this is traditionally where one of those limitations could come to a scope of service. So they say, yeah, I want a personal insurance plan, but I'm not prepared to give you any detailed financial information. Well, then that's going to put you at a disadvantage. So that would be a limitation that you would state up front. It also does allow here that you can provide transactional advice without determining suitability, but we need to know when that happens. And also you need to prove in writing the difference of when that happens. The key part to this is that also that the client, as you can see, relief is only available for A of A's if this instruction is provided in a document that is signed and dated by the client. And this clearly, there's a clear acknowledgement from the client as to the advantages of having the suitability based on the advice. So once again, most of this can be covered off in a terms of engagement and a scope of engagement sign-off, and it's not too hard to do. So how does this help you? What we tend to suggest is that if you have given a client an outline of what your advice services and products are up front in an About Us or Terms of Engagement document or a product and services guide, and so the client goes, cool, I know what you do, and you've said we specialise in providing mortgage and insurance advice for families, and then they say, cool, we would like you to place a mortgage for this, but we don't want any advice on it. Then you can say to the client, so the way you would describe the limitation would be, well, we offered the client one of our mortgage and insurance plans. The clients have declined to do that, and they've said they would just like us to place a mortgage for $100,000 for whatever they're doing. And that way, if anything else goes wrong with their insurance, it automatically shows, well, we offered them the plan, we gave them a list of our services that we do provide insurance and the benefits thereof, but they've decided they didn't want that, so therefore you're not liable if anything happens from an insurance point of view. Here's a little case study. This was a recent case where we had a client who says, we offer insurance advice. They use a secondary disclosure, they use a primary or an RFA disclosure, and of course the RFA disclosure is a wonderful document. It just states that I'm a registered but not authorised financial advisor. I can provide you advice on life insurance, health insurance, disability insurance, etc., etc. And here's 3 ways to complain about me. The advisor used a fact find which has a tick box scope of service on the front of it, as well as a privacy declaration and an acknowledgement from the client that they accept the scope of service. The scope of service they use, the document just has tick boxes for each of the products available in insurance, and so there was ticks on life insurance and health insurance, and the others, trauma, TPD, income protection, mortgage protection, I think that was about it, weren't ticked. But there was nothing written to state why life and the other products weren't mentioned, or why only life and health was ticked. When I looked at the file, the advisor had gathered some facts in relation, and there was some sum insured written down for the life insurance, and the health insurance options were ticked. And I said, well, why wasn't the client interested in the other covers? And he said, well, they were too expensive. And I said, well, how did the client know, they were too expensive? And he said, oh, well, we actually went through, I had my laptop there, and we went through and we did quotes, and I quoted trauma and TPD, and we looked at mortgage repayment as well. And I was like, whoa, So you did discuss those benefits and you did some quotes for them for the client to be able to decide whether they wanted them or not. And you went, yeah. So my questions to you is, if you just ticked health and life and that's what they put in place for the client, it's no worries, we're all good to go. No, the limitations of the advice should have been stated on that scope of service. Or no, it's not okay, the scope of service should have included all covers discussed and quoted, and the statement of advice should have included the statements of the rationale. Which is the right answer?
Okay, I've got a poll coming up, and I've had to refresh the poll slightly because I ran out of words on the options. So what we've got is a multiple checkbox poll,
cool.
Which has got 4 different items. So you can tick more than one item if you think it applies in this particular case. So I'm going to stick the poll up, and hopefully I won't finish it too early. Okay, so it should be up on your screen now. We'll give you sort of 30 seconds or so to answer. So a third of the people are on, about 15 people have voted.
We do need to get some poll music, David.
We do. I think
I'll find an elevator tune on
perfect. I might have to have a look at the settings on this system and see if we can.
Some little lounge music in the bit.
Yeah, and it gets
sing for you.
And it gets faster and faster as we get close to the end. Okay, 10 seconds. 9, 8, 7, 6, 5, 4, 3, 2, 1, go. Okay, let's launch the results. The numbers here obviously will add up to more than 100. So, but 31% said, nobody said yes, no worries. They obviously felt that the advisor in question hadn't met their obligations. 31% said the SOS statement of service should include limitations, and 78% said the statement of service should include all covers discussed and quoted, and 59% said the statement of advice should have also included rationale for the limitation.
Very good.
Okay.
We're going to make FMA investigators out of this lot yet. Right. This is an interesting one for me because it all comes down to the definition of what is financial advice. So financial advice is giving an opinion or a recommendation on either acquiring, holding, or disposing of a financial product. So in this case, the question really is by doing the quotes for the client, did the advisor give an opinion or a recommendation about those other key products? It's hard to tell. And I guess what we would have to say is that if we looked at it just in, because I always like to think of this in an evidence point of view. So for example, if this client suffered a trauma or an income protection type claim later on, what would the client think happened in the scope of service? They would potentially only have a document. In fact, they would only have the record of advice the advisor sent out, which was actually quite limited as well, which stated that you wanted some life insurance and health insurance, and here's how the sum insured for the life insurance went and the company we chose, and here is the health insurance and the options and the company we chose as well, they go together. And I wasn't too fussed about the product recommendations. They all look pretty good. But what it doesn't say is the full story of the discussion that they had. So I would suggest that the scope of service was, we discussed and looked at options for all types of cover, and whichever ones they did do quotes for. And after looking at the quotes and the recommendations, you decided that you're only interested in acquiring life and health insurance. So the scope wasn't actually, I don't think the scope was actually limited in this case, because they did discuss all the products that he would normally discuss with personal insurance advice. So he could have actually said the scope of service was to look at a personal insurance plan for this client. After looking at discussing quotes and options, the client made an informed decision about only implementing life insurance and health insurance for your personal insurance plan. And that's the difference for me. The scope of service isn't what the client buys. The scope of service is, well, what advice did we give and how did we make the decision to only buy life and health? So really what I'd probably look to see is that the scope of service should have included all covers discussed and quoted, and that the statement of advice, so we discussed trauma, but you decided not to take it. We discussed TPD, decided not to take it. We discussed income protection, decided not to take it due to price. But at least it then shows the client made an informed decision about not taking those covers. So yeah, interesting. Right, Code Standard 9. What are we doing with this one? We must provide an explanation of the services provided that is sufficient to enable the client to make an informed decision about the financial advisor service. What they're trying to do here is that they're potentially saying, well, you should explain to the client what you do so that they can make a decision about whether or not your service is what they would like to take up. Interestingly, in a roadshow, when we ask people what they do, they potentially could say the same things. I'm a financial advisor. I do mortgages and investments and insurance. I do investments, mortgages and insurance. But then when we look at and mortgage advisor is actually a really good example. Not all mortgage advisors provide the same level of advice. I've got some mortgage advisors who provide a budgeting and I guess cash flow and debt management service on top of implementing a mortgage. So they actually go a bit further and a bit deeper than somebody who just says, do you want a mortgage? How much? What's it for? Let's go and find a provider. So while we say the same thing, how do we know whether the client understands what we actually do? So the recommendations we usually make around this is then giving this is where that about us or a product and services guide to the client to go, hey, here's what we actually do and actually how we do it. Is that the service you're looking for? And it feeds back into then, well, what scope do we agree we're actually doing for the client? All explanations, and for AFAs, this has to be in writing as well. So for a lot of them, it is making sure that the client has understood what the AFA is doing, and that either that or the client has instructed the AFA that an explanation under the code standard is not required or not needed in writing as well. So this is where we're starting. This is the bit at the end there where the client has said to the AFA that an explanation is not required. This is the part of them that needs to be in writing. So it needs to be in writing that they don't need it in writing, if that makes any sense. How does this help you as an advisor? Obviously, providing that information is up front. Asking the clients then how they want advice communicated. So, for example, they may decide that they would like to receive the advice all via email rather than paper. Some clients might want to say, I want the details, the product details sent to me, but I'm happy to do the rest over the phone, remembering that we do have to have the advice in writing. Also, the research bit, the client can choose not to receive research. Clients can choose not to receive, or potentially all quotes or all examples as well that you do for your products. So you and the clients can decide between you how you're going to have the relationship, or how the advice is going to be communicated in your particular engagement or relationship with them. The Advisor X standard. For those of you who don't know who Advisor X is, I'm not going to tell you who Advisor X is, but the Advisor X case was an AFA investment advisor who worked for a company that was part of a QFE. The QFE, I think through their own internal audits, found that the AFA had not met the code standards required, and so they reported the AFA to the FMA, to the regulator, which is actually, there's a requirement of their QFE status. What that AFA then, somehow it ended up in front of the actual full disciplinary committee, which was quite a surprise. The reason it was a surprise is that no clients had made any complaints, no clients had suffered any loss, and there was really, I guess, no victim in this other than the the code standards not having been met by the AFA. What they found was that basically the authorised financial advisor had just not kept records in writing or adequate information about the services that he was providing to clients. So I think when the auditor turned up to go, well, why has the client got their $1 million invested here, here, and here? The advisor went, well, that's because that's what we decided. And they go, well, have you got the advice in writing? And it wasn't in writing. They couldn't find it. So the information required to be recorded under the code standard in relation to each retail client must be sufficient to demonstrate compliance with code standards 5 through 9. So, for example, you've just got to be able to show each step of the process, and that needs to be stored, though there is a change in how that can be stored as well according to the code. How does this help you? As always, and we've always said this, is that evidence in writing is gold. I've had file notes fall out of files that have helped us describe how suitability analysis was done. A key one for us has always been file notes. We always say to advisors, if you are talking to a client about their advice or their products, or you're talking to a product provider about a client over the phone, rather than writing a separate file note and storing that, we suggest sending an email to the person you were talking to, just confirming the discussion. We discussed this and this was the outcome. That way, if they ever come back to you and say, no, what about this, what about that, then you can make sure you've got the whole issue covered or met their expectations. But it just provides, what we think is a bulletproof file note. It asks clients for emails as well. So if they've got questions or if they want to write something to you, get them to put it in writing. Code Standard 13, I think this is our last one actually, is that a financial advisor must record in writing adequate information about personalised services provided to a retail client. They've actually changed this now whereby that you can have records, information or documents held by a third party. So, for example, advisors were relying on the systems that their employers provided, or they were putting it into a third-party system, like a cloud-based system. But what we have to make sure is that if you are using a system that's not in control of your business or your entity, is that the service will at least be able to keep them for as long as you would have required. So the other example of that would be document storage. So if you were going to keep the records off in the document storage, that you have to have them kept for at least 7 years. So how does this help you? I guess the big one really was the use of online CRMs. And our advice when you're ever going into a service that's a third-party service is make sure you check it out. So where's it stored? Where's the information? How's it backed up? How do you do disaster recovery, etc., etc. The second one is how would you get your records off that system if you left? It's a bit like going into any agreement. You've got to know how you're going to get back out of it. We have had people move off one CRM system onto another, and if any of you have been through that, you have my commiserations.
I know that one's a nightmare.
Yeah. While data can come out of them, sometimes things like file notes, things like attachments, aren't as easy to come out in a systematic way. So I've seen guys end up with, 2 or 3 CDs just full of documents in potentially no particular order. And that was all the attachments that were on a CRM, and there's no way of linking it back into the new CRM. So yeah, it is an important one. The good thing is that you are able to do it, and it is, I guess, standard industry practice that is approved, but make sure you understand the regulatory obligations and make sure the data is safe.
It goes back to making sure you do appropriate due diligence on wherever it is you're going to put your data. That includes things like
the due diligence is, we've brought it up a couple of times. We've talked about the research. Do your due diligence on the product research. Don't just go, oh, well, there's my mates will use it, must be all right. Actually go, well, do I understand how a QPR star rating works? And it's really good, because if you understand it, and we've seen this happen where an advisor sat down with the FMA for a monitoring visit, and they said, well, why are you doing this company? Oh, I use it because of this and these ratings. And they would explain the ratings. Well, this is the way the ratings work, da-da-da-da. And he goes, so why? And these score well because of this, and it's these definitions. And then what? Imagine being able to answer a question about it 2 or 3 questions deep without blinking. Then the regulator goes, you know your stuff, we're dealing with a professional here. Whereas if you go, I use QPR ratings, they go, okay, cool, how do the star ratings work? And if you go, oh, well, I think it's to do with the definitions and the score they get, and if you don't understand how the score's made up,
don't use it.
You should understand it, is I guess my advice. So their due diligence is a really good, it's a professional thing to do in any business.
Yeah, it's interesting that there's one in the investment space, one research provider investment space that uses star ratings, but they also have qualitative research, so a combination of quantitative and qualitative. And it's interesting the number of advisors that rely solely on the star rating, which is pure quantitative.
It's interesting you say that, because it comes up now and again too with the insurance side. So someone might say, oh, it's got an A+ rating, so that's why we recommend it. Yet when we look at the definition, when we actually dig a bit deeper, there are qualitative reasons for choosing a product provider that potentially are far more powerful for advisors. So for example, a product provider may have an A+ rated product, but they may have really harsh underwriting for your target market or certain clients. So then you go, well, actually, I won't go there, because it's no use getting an A+ rated, or not being able to get underwritten for an A+ product, whereas I can get an A rated product that's underwritten fairly and with better terms, then the client's potentially better off with that. So the rationale for choosing the provider may be qualitative reasons as much as it is product ratings.
Yeah, and to be honest, the ratings are obviously just one element of the mix, aren't they? It's not just
absolutely
purely, yeah. Cool. Is that mine?
Changes to CPD. I will hand that over to our resident CPD expert.
Thank you, Barry. Can you put me? So I'm going to talk about a couple of two changes actually. Changes to competency standards, which is Code Standard 16, and then changes to the code in relation to CPD Code Standards 17 and 18, and then what that means from an NZFEA member point of view. Let's start with Code Standard 16. I'll rush through these reasonably quickly. Up until the 1st of May this year, i.e. under the old code, the competence standards were, some of the competence standards were subject to sunset clauses. So, for example, if you had a graduate diploma in business studies, financial planning or insurance from Massey, then under the old code, those qualifications would no longer be relevant as an alternative to some of the levels in the certificate in financial services level 5, which is required for AFA purposes. The Code Committee have decided to remove those sunset clauses in relation to many of those alternative competencies. So they have basically continued into this year and will continue going forward under the new code. So if you have a graduate diploma in business studies, either financial planning or insurance, then you want to look at level 5 certificate, you will be eligible to use those as some of the qualifications you have there as alternatives against some of the levels in standards in the certificate. Sorry. Okay, goes down to 17 and 18, which relates specifically to CPD, ongoing CPD. I think the key elements here are that under the code there is no longer a recognition of unstructured CPD, or at least it's not counted against your obligations under the code. And what has happened is that rather than going, what we had under the old code was 20 hours total, of which at least 10 must be structured. We're moving to a pure structured environment whereby you have to do 30 structured hours over 2 years as an AFA. They've also clarified some of the definitions around what is structured CPD, and it's become a little bit more specific to the advisor's needs. So one of the key components of structured CPD is that it is relevant to you as an advisor, your particular professional development needs. And the code has clarified that quite in a much more structured way. So before it was sort of very vague that it was relevant to your needs, but now it's quite clear it needs to be relevant to your particular needs, not necessarily a generic need. It needs to be delivered by a recognised educator or a subject matter expert in the subject that's being presented. Similarly, there needs to be some way of it needs to have predefined outcomes, and there needs to be some mechanism for assessing those outcomes. And they've also clarified the situation in relation to product training. Initially, it wasn't going to be recognised at all, and then it got adjusted to recognise that if you are going on to technical product training that is not promotional, then potentially, and it meets the other criteria, then potentially it could be recognised as structured for your particular purposes. So I think the changes to CPD have been quite positive. I think some of the clarification that's come out has been very useful. What does it mean from an NZFAA point of view? So up until earlier this year, we were aligned with the code. So all members had to complete a professional development plan at the beginning of each year, and have 20 hours structured, 20 hours total, of which 10 must be structured CPD as part of their requirements of membership. We are looking now to realign our members' obligations in line with the code. We have a number of our members, obviously, who are AFAs. And one of the core tenets on which we've been founded is that we will provide mechanisms through which advisors can gain the minimum level of CPD requirements. So at the moment, what we're doing is we're going through the process of looking at our service offering and updating it to enable us to be able to deliver at least 15 structured hours a year as part of your membership through the membership program. So over the next few weeks, we'll hopefully be able to finalise that, and we'll be coming out with an announcement that our obligations will change in accordance with the code. But we'll also be able to provide you with vehicles and mechanisms through which to attain the minimum levels of structured CPD. Interestingly, I had a conversation with the FMA earlier this week about when the new code comes into effect from the 1st of May. What does it mean for CPD prior to the 1st of May? So the FMA have come out and stated that whilst the new code applies from the 1st of May, the new CPD obligations relate to the CPD periods from the 1st of January. So the CPD period under the code is from the 1st of January to the 31st of December, or from the time you were authorised to the 31st of December in each particular year. And so what they're saying is that CPD obligation, the new standard code standard obligations, the 30 hours over 2 years, apply from the 1st of January this year. So any CPD you've completed in the first 5 months or 4 months of the year will count towards the your obligations. And they've also indicated that potentially some previously some training that was previously considered unstructured may well now fall into the structured category. So you may find that some of the stuff you've done in the first 4 months of this year could now be counted as structured CPD because it's relevant specifically to your needs. Any other comments on that, Barry?
Yeah, I guess the key things for me that there are while unstructured is gone, I think some of the things that were previously unstructured that advisors were attending would now be considered structured. So I think that's a real positive.
Yeah.
The key when you're putting your plan together would be, my recommendation would be to try and be quite specific with, for example, keeping up to date with the products that you provide advice on, keeping up to date with changes to regulations, keeping up to date with reviewing and updating your processes, and then pick one or two competency things that you would like to work on in the year, with an aim of which organisations are going to be picking those things up. So, for example, if you were redoing your plan and you knew that there was going to be a conference on changing your advice process to better communicate to clients, for example, then you'd want that in your plan. So and the rationale behind that is that it won't count as structured if you go to a session that doesn't relate back to something that is actually in your PD plan. So make sure that. Yeah, sorry.
That's a good point. One of the things that we have as part of our online CPD program is for all advisors, we set them up with 2 learning outcomes at the beginning of each year, and one of those is keeping up to date with regulation and keeping up to date with product changes.
Perfect, and that encompasses a lot of what you'll end up doing.
Yeah. So today's session, for example,
going to a product launch and saying, "Hey, we've launched a new product," that doesn't count. But if you go to a product launch where there is training and then there's a follow-up accreditation, that's CPD.
Yeah, and like today's session would be relevant under the, keeping up to date with regulation and its effect on us.
Excellent. Thank you, David. So look, I guess the key messages out of today is that while you might be a registered financial advisor, I guess the code helps us understand how the regulator would determine what is best practices or what are reasonable practices or what they expect. As always, documentation will save you, but the new code does indicate that there is a lot of flexibility around how your advice process and your advice can be documented and communicated. So remember, clearly, concisely, effectively. If you can demonstrate that, you're a long way to making sure that you're not going to run into trouble over, what could potentially be an administrative error. We're actually probably over time, aren't we? So look, as I said before, fire through any questions through to David that you have about what we've discussed today, or any other code changes that we potentially haven't discussed, that we've tried to cover off the key ones. And hopefully what you've got you're thinking about your current process. Are there any changes that you can make, and what will you change? And obviously you'll be getting the email from David after the session, which will hopefully have got you thinking. So yeah, go and crack the code.
Right. So interestingly, there were no questions come up during the session today. So obviously very comprehensive in your explanations, Barry.
It's a highly exciting subject. Code,
it is an important one, though, and I think it's important, as you've outlined. It's not just for AFAs. The implications of the code are broad-reaching across the advice sector, and I think all advisors would do well to use the code as a reference point, even if they're not legally obligated to do so.
Yeah, look, and we're definitely not trying to imply there is any legal obligation. There isn't, but we are just trying to say that if you were looking for a way of determining what would be considered reasonable practices of a professional financial advisor, and I mean I don't get too fussed when we do reviews of advisors whether they're RFA or OFA. It's just, are you doing are you providing a reasonable practice? Is it efficient and is it professional? Which is why we talk about terms of engagement. Well, it's just a professional thing to do rather than a regulatory requirement.
Exactly. Barry, cool. Thank you once again for your time and the effort you put into this. Hopefully it's been of value to the audience. A little while after the end of the session, you should all get a follow-up email with a reflections questionnaire. So if you want to take advantage of the structured CPD, then you'll need to complete that. And hopefully we'll see you on the next session, which I think is in September. Is that right, Barry? It might be.
I believe you.
Yeah, I think it's September. Look on our website, and we'll catch up soon. Have a nice weekend, everybody. Thank you, Barry.
Thanks, David. Bye.